Hi, I'm Tom Mihawk, and welcome to Investment Basics. This course is a short version of what I've done previously. I think I called it Investment Fundamentals. This is designed for MBA students, undergraduates, non-program students, and also others who just want to learn about what does it mean to invest. So this is a wonderful little graphic, and it shows that we take what we earn, and if we spend part of it and save the rest, we have the chance over time to grow what we've, well, let's do it this way, to grow this way. There we go. To, to grow by investing. And it happens exactly like that. It starts out small and gets larger and larger over a period of time. So what does it mean to invest? It means to be able to keep up with the milk and the eggs, the cost of them. If you put your money under your mattress in 5 or 8 years or 10 years time, you won't be able to afford to buy the milk and the eggs anymore. The price of goods and services in a healthy economy generally goes up. Not a lot necessarily happens at the time of recording right now. We're having high levels of inflation, higher than we've had in 40 some years. And that means that milk and the eggs are getting more expensive faster. But in general, a moderate level of inflation is typical. Moderate meaning 2, 3, 4%, something like that, is typical for a healthy economy. So you want to implement a plan for your money to grow over time greater than this rate of inflation, this growth of goods and services by investing in stocks, bonds, or giving your money to an institution that'll invest it for you and give you a return for it. By the way, along with these slides are along with this video or slides, and I'm going to try to put these slides in the notes. So go to the notes, look for these slides so you can refer to them. If I don't mention everything on the slide, you'll have the hard copies that you can look at, okay? Risk, return, volatility, and time. We know that returns and risk are related. We know that, for example, if you get a high rate of return, you're likely to have a greater risk in that investment. Now, the converse is not necessarily true. It doesn't mean that if you find something that's really risky, it's going to pay a lot in return. It might just be crap. It might be very risky and not pay much. But in general, if you find a highly returning investment, it's going to be riskier. Now, the way we can mitigate that risk is by investing for the long term. Notice these three investments or securities, whatever you want to call them, A, B, and C. A does this, right? Does this over time. No volatility indicated by upward and downward movement. No variability of value. Always like this. B, a little bit more, right? And C, a lot over time. I ask students, what investment do you like? And they say, well, I like C, or well, I like A. Well, what really counts is how long you're going to invest. If you knew that C was going to do this, with this up and down, and you knew you had 40 years to invest, like in a retirement plan, well, why not own C? If you knew you were going to be married in a year, go to grad school in a year, or get divorced in a year, have children, or start a business, or something like that, buy a home, well, maybe you'd want to invest in A. Very steady, solid rate of return. No big changes. So risk, return, volatility, and time are all interrelated. Sources of returns in investing come from capital gains. And the capital gain is the difference between what the value is today. It's really what you sell it at, if you sold it today, and what you purchased the asset for. You're looking for gains. You're looking for increase in value of the asset. Dividends and income. You often receive dividends with stocks every year, or they're paid maybe quarterly, but they come in every year. And then interest from assets like bonds or money that you invest at a financial institution, maybe like a bank. Liquidity is important in an investing plan. Liquidity tells you how fast you can turn an asset into cash. Paper money and coins are by definition the most liquid, right? Marketable securities are Liquid meaning you can sell them. You can't do it instantaneously, but you can do it very quickly. Homes, investments in private equity, investments in artwork are illiquid. You can sell your home in a week, but you might have to sell it for half price. But if you wait for 3 months, 6 months, 9 months, you should be able to get a fair price, a market price for your home. In general, you pay for liquidity. It's a benefit. The more liquid an investment is, the less return you're likely to earn from it. It's valuable. You need liquidity to pay your bills. You can have high net worth, but if it's all in assets, a private business, home, cars, for example, but you don't have any liquidity, you can't pay your bills. So it's important to have liquidity. Investments, we lump investments into what are called asset classes. They behave similarly in this, as in this example put together by Jeremy Siegel. Stocks act similarly. They have volatility. Notice the jagged line at the top there. That's indicating movement in price. Bonds and bills behave similarly. Notice they have less movement, less volatility. Gold, US dollar. We think of investing and investing plans by, in terms of allocating our cash, what we've earned or what we own, to asset classes. Notice that from 1802 until when this was produced, I think it was 2012, but I could be wrong. 2011. No, that's the one on the right. Let's say the one on the left is 2012. Notice that stocks produce the highest return. In fact, Jeremy Siegel finds 6.6% over all those years, beating bonds that he finds return 3.6%, and bills, which are shorter term debt security, typically issued by governments, 2.7%. Notice in the chart on the right, notice that for the Standard & Poor's 500, a list of 500 stocks that are broadly representative of the U.S. economy, between 1996 and 2011, notice that in 1 year of investing, your return was between 54% up and 43% down. Asymmetrical, more chance of it going up than going down, but still big difference. And that more chance of going up is what gives it this positive slant. More years than not, it goes up. Okay? Notice that in 5-year periods, the overall return for 5-year periods during 1996 to 2011, 29% up and minus 12. And notice that for 20-year periods, it never had a down year. The lowest was 3% return and the highest was 18, which is why it's important to invest for the long term. Owning securities, Warren Buffett, one of the best known and probably one of the best investors over the last 50 or 60 years, buys stocks, buys investments in companies, and owns them for the long time. And this is why. The common investments are stocks, otherwise known as equity because it's ownership, bonds, mutual funds, exchange traded funds, which are a type of pooled investment like a mutual fund in some ways, real estate, alternatives, commodities and metals. We're going to talk about all those, by the way, in this quick basics series. I have 5 others coming. Stocks, bonds, alternatives, retirement, and homeownership, and mutual funds, by the way. Diversification is the practice of mixing assets to reduce the portfolio's risk. What happens is some assets in the portfolio go up when the market goes down, and some go down less when the market goes down. And when it goes up, you may not make as much as the very best choice, but this diversification can lower risk. There are 2 types of risk we look at, unsystematic and systematic. Systematic I think of as the risk of the system, the whole market, wars, recessions, changes in government, increasing or decreasing tax policy affecting negatively investments. Unsystematic risk has to do with companies. Are they picking the right products? Do they have the right sales approaches? Are they successful with what they design? These 2 kinds of risk, systematic and unsystematic, make up the ways we choose companies and bonds and other assets to invest in and diversify. These are challenging issues, but they're important to know. Beta, alpha, passive and active investing. When the market goes up and an investment goes up a similar amount, we call the beta 1, meaning it moves in the same direction and moves the same amount. If the market goes up and the investment is down the same amount, but it's down, we call that a beta of -1. When we're investing, we don't want to pay a lot for beta. If the investment moves as much as the market moves, we don't have to think a lot, right? We can just own securities or investments that do what the market does. Alpha, on the other hand, if the market's up this much and the investment's up this much, we call that alpha. It's return in excess of the market. We would pay for alpha, pay more than we would pay for beta. Passive investing is investing in a pool or a list or a group of stocks or bonds or whatever, real estate, designed to mimic the average movement of a market. You're not going to outperform the market, you're going to get the market return. You're getting beta. And again, we want to pay very little for beta. If you can find a way to beat the market and get alpha, you would want to pay for that. Index investing is the same thing. Passive and index investing are the same. Active investing is where we try to beat the market. We try to pick stocks or pick bonds or pick investments that do better than the market. If it's done consistently and done with a margin greater than the market return, we should pay more for that. That's called alpha, and that's active investing. Investing regularly is important. One way of doing this is dollar cost averaging. We're investing every month or every week or every year. Has the effect when dividing through, because the stock price, for example, goes up and down, has the effect of lowering the average cost of what you're investing in. Investing regularly is a great way to lower the average cost of what you buy. Keep your investments for the long term, as I said Warren Buffett does earlier in this video. Buy and hold. Notice that if you invest in all days, and this is examples from January 1, 1980, all days you have $708,000 growth of return of a $10,000 investment. Notice if you only miss 10 days, if you say, you know what, I think I'll take my money out of the market, I'm worried, but you miss the 10 best trading days of the year, what happens is the return goes from 708,000 to 340,000. It's very difficult to predict the market. Traders do this, day traders you hear about. These people may be experts. If you have a job that's not trading, invest generally. Have a bias for investing generally for the long term. All things equal, keep your fees low. Notice the difference between a 1% expense ratio, and we'll talk about what that means certainly in the mutual fund video, and a 2.5%. 1% expense ratio grows to $4.3 million, where a 2.5% expense ratio grows to only 2.7. Big difference in keeping fees in your investments low. This is another important one. Small cap and large cap growth and value. This is just a way of describing stocks. And small cap, the capitalization is a number of shares outstanding times the current share price. Smaller companies would be like Polk Audio maybe, or Outback Steakhouse or something like that. Large companies would be like Pfizer and Google and Ford and GM and Apple, for example. It's a proxy for describing how large the company is. Value and growth tell you some measure of the cost of the shares. So if you're paying a price to earnings ratio of 20 times, that's the share price divided by the current earnings per share of the stock. It sounds like a very detailed thing, but it's just a measure of value. Some companies trade at a high price to earnings ratio, meaning people expect high growth. Other companies trade at a low price to earnings ratio, meaning people expect lower growth. So starting and maintaining an investment plan. Determine how much you can set aside, be aware of your time frame, choose investment possibilities, and implement. Don't wait forever. Do your research, narrow your list, and implement. Keep learning, evaluate your results regularly. If you use an advisor, stay involved, don't delegate and forget. A 0.5% return for 40 years makes a huge difference. It's hard to get 10% in 1 year, but not hard to get a 0.5% by reviewing, tracking what you're doing, asking, keep learning. 0.5% per year is very possible, and a 0.5% for 40 years is a huge difference. Have a bias for stocks. Own more stocks than most things for the when you have a long time. Use diversification to reduce risk. Be aware of taxes. Keep your taxes low where you can. Keep your fees and your costs low. Some active funds and investments do beat the market. So while you should have a bias for passive investments, index investments where the fees are lower, where active managers show they beat the market and they're consistent and exceptional, use them. And as I said in the last one, review your performance regularly. A 0.5% makes a big difference over 40 years. I'm Tom Mihawk. This has been Investment Basics. Stay with me for Stock Basics coming next.